Unfiltered opinions.
Introduce me.
Sometimes you have ideas and you're not quite sure why.
As you secure the bag.
Sometimes you meet people and realize there's probably a reason why you stayed in touch.
Just listen.
Sometimes all the pieces just come together by themselves.
I'm Jimmy Moyaha.
And I'm Simon Brown.
Welcome to Insider Exchange.
And in our deep dive this week, we go back to school. We're going to look at the defined benefits, defined contributions, and everything around that. We're going to look into just where this all started from, what it all looks like now, and what it means for you when you're looking at your retirement, when you're looking at your pensions or your future earnings. Just a couple of things to think about. Let's start with the origins. I like origin stories.
Oh, you want to go all the way back?
All the way back.
the
1980s.
Let's start in the 1880s. Then. All the way back.
Okay, maybe not that far back.
So the idea of retirement was that Germany had a war and Kaiser Wilhelm, whoever he was, had all these people who had come back and they were flooding the labor force. So he introduced retirement at the age of 65. Life expectancy was about 62. You weren't supposed to get to retirement. And how come we still have a retirement age of 65 and then, you get sent off home? Anyway, that's the whole retirement concept hasn't adjusted in 140 plus years.
Well, technically, we don't have a retirement age of 65 because at 65, you then start your career in politics. But anyway, let's go on.
Career change. So in the 80s and prior to the 80s, and you see this in a lot of the UK and US, and it's one of the Rainnet businesses, it was defined contribution. In other words, on your last day at work before retirement, they took your salary, worked out your years of service, and paid you a salary for the rest of your life, a retirement benefit for the rest of your life. That was guaranteed. And the risk of that was on the provider, which is why companies like General Motors had such huge problems because they had massive liabilities. And we've got the same issue in the UK. And in fact, companies can now buy insurance for that because they're just behind the curve. They can't retire their staff. What we did in South Africa is a lot of our, as we're sort of getting into the mid-80s, a lot of our pension schemes had excess money. In other words, if they were going to pay you a defined benefit, there would actually be money left over in the kitty. So the unions came along and said, how will we want our money? We want defined contribution. In other words, if I've put in X, I must get a pension on X. So my grandfather retired in, I think, 82 or something like that. And he was one of the last that got defined benefits. So he was given a salary for life at a certain rate based on his last salary. And then it switches. So now what it is, and PRC is the defined benefit, where you work for Transnet, you leave Transnet, and it's one of the problems Miriam has had when she was the boss there. You leave, you've got your guaranteed income. Adjusted for inflation. Now that inflation part gets tricky. Transnet was getting only 2% increases during the early 2000s and late 90s. Inflation was not anywhere near 2%, but they were trying to balance those books. We then moved to defined contribution, which seemed like a great idea when there was excess money. Remember the massive bull market into the 80s. The US had broken the back of inflation. Gold had got to 850, although then didn't see it again for decades, but that's another story. And the problem with defined contribution is it matters how much money you put in. Now, there were a couple of challenges to that. One, you might draw money. In other words, you leave a job, you can take money out, tax implication. Two, you don't put enough money in. And three, fees. I started an RA in 1994, which you would think would be really cool. Here I am 31 years later or 30 years later, and I'm at a Reg 28 age.
I'm going to look at that RA and say, I finally got money to retire.
The only person who made money from that was a certain green insurer.
That provided you with a RA. Ah, lovely.
Oh, and the person who sold it to me, I guess, made a lot of money to the salesperson.
Not you.
But it fundamentally brings the risk onto the individual. And that's why I quite like the two-pot system now, because you can access some of those monies, but the olden days of retiring and then just cashing it all out and having a holiday are gone. 2/3 of that money you will never touch for as long as you live until you get to Reg 28, 55 years old. But it's put the pressure onto the retiree, which, we can debate which is right. I would have preferred defined benefit, but then you and I don't have proper jobs, so there wouldn't have been any benefit. People don't stay in their jobs for 40 years. My grandfather literally left school, got a job, worked until he was 60-something, and then stopped and then died 4 or 5 years later. That's how it rolled in those days. And then you've got the choice between, and then when you cash out, you can take a third in cash, and the other 2/3 have to buy you an annuity.
But if your annuity is based on a retirement benefit structure, then you're golden either way, because that's indefinitely until...
Depends what annuity you buy. So there are two types you can get. Guaranteed annuity, which is essentially an insurance product, and that says we will pay you an amount of money until you die, and you can have some T's and C's. It could be you and your partner, so the death of the second. It can be inflation adjusted. It can also have small lump sums at the end. So you can structure that around, but it's essentially an insurance product. And certainly that gives you certainty. So you get to your retirement age, you take your 2/3 of money, you go buy a guaranteed annuity from one of the insurance companies, and they promise to pay you an amount adjusting for inflation. But read the T's and C's. Some of them won't increase more than, for example, 8% payment per year, regardless of what inflation is.
But now, in the case of the defined benefit, let's take a civil servant in that scenario. That 2/3 annuity only relates to from 1 September, because everything up to 1 September would be in the vested pot that would still be under the old regime, under the old, this is what you are getting for life kind of regime. Only the new portion is what we're now going to buy an annuity with.
Well, the old portion's there. It will still be around. When
Yeah,
you
the
hit
old no.
retirement.
So the old portion is under its own conditions where they'll still pay you out and everything, and it's that salary for life kind of setup. But the new portion is what you can then go and say, I want to buy a guaranteed annuity from this, and is that based on contributions or on benefit?
So it's based on contribution. Basically, it's a single payment insurance product. So you've retired. You've got, let's say, R1 million in your 2/3. You take it and you buy that annuity, and the insurance company then promises to pay you. And it's an insurance product because essentially it's actuaries who are going to look at you and try and work out the two moving parts. What can we grow this million by
Before this person dies.
Pretty much.
Yeah.
The living annuity is where you basically you put it into an investment, and you can draw between 2.5% and 17.5% per month. Sorry, per year, my bad. And the risk there is that you run out of money, that you just run out. And what you see, a lot of folks sort of do a blend of. So like medical, they try and cover their medical expenses with a guaranteed annuity and then living from the rest. But then you're also subject to watch out what your fees are. There's some heavy fees out there at the same time. But there's also the challenge of that, you markets crash and then you draw down you've been drawing 4%, which is that sort of magic number, but markets crashed. So your 4% is actually a bigger rand value and takes a bigger dent out. Challenges around that as well. Also, how you invest it. You've got more flexibility. Do you want to go offshore? Do you want local? Do you want to be conservative? Do you want to be aggressive? I think a mistake that I've seen some folks do in their hit retirement is they de-risk their portfolio aggressively. You're 65. If there's two of you 65, one of you statistically is going to make 90. You've got like 2.5 decades of living. You don't want to go into cash and bonds. You want lots of risk because you need to take. And what I say to folks is always try and have, in an ideal world, you would have the next sort of 3 years living expenses in cash so that you don't have to draw if markets are falling. You're only drawing when markets are running.
And the nice thing about it now is when you're looking at your retirement at this particular stage, as in 2024, we've gone through a lot of market volatility, a lot of bearishness, a lot of whatever. If we're about to start a bull run for the next 3, 5, 10 years, you want to be getting in at the bottom of that bull run, increasing your risk to say, I want to maximize on that as much as possible, because the reality is, as you said, people are now living longer, and that means you're having those requirements longer into your retirement.
Yeah, absolutely. And therefore you must take the risk. And you must, it's also, it comes back to, and you and I know this, don't panic when markets do collapse. And don't panic when they run and they think, oh, it's too high. Like, my Satrix 40, I did a debit order for ever and a day. And I remember in the collapses I started it in December 2000 when it first listed. And in the collapse of 2008, and like, oh, there's my little debit order going off. It didn't feel very nice when I did a debit order and a month later we were 20% lower.
Ouch.
But you know what? Every one of those points that I bought at, and even the rally in advance, the 2006 rally when we were up 40% in a year, off went my debit order, and every single point there is like, I mean, I was buying it, I don't know, what, 10, 12, 14, 15 Rand. Now we're at 75 Rand on that ETF.
So there is going to always be opportunity, always going to be value in the markets, but don't listen to us. Speak to financial advisors.
Yeah.
You've seen the disclaimers. Don't say we gave you financial advice. We are just sharing our thoughts, our opinions, what we've learned and what we've seen. Hopefully that adds value to your life. If you want to make financial decisions that affect your life, go speak to a financial advisor. Again, read the disclaimers. We have them on the show. We have them for a reason. Don't come back to us and say that it's our fault that your retirement didn't go as you had planned because you had spent your money on things that didn't involve us. On that note, we'll leave it there. And we wrap things up with Investor Insights this week. We are taking a look at the travel rule that has been put forward by the Financial Intelligence Center. They have put forward something very interesting related to crypto asset service providers. We know we're getting into the December period. We know that typically we see a crypto bull run in the December period, but there are some serious implications from an accountability point of view that people need to be aware of. Of course, if you're doing things the right way, doesn't really matter to you. But the travel rule, nonetheless, is directed at ensuring that South Africa is more aligned with the Financial Action Task Force's requirements to get us off that grey list. So the travel rule basically says that as a crypto asset service provider, a Luno, a Vala, all of those guys, I need to now be accountable for tracking the origin of the transfer as well as the destination of the transfer, right? Whoa. So in the past, I just processed it and said, I got an instruction from my client to send money from this wallet address to this wallet address. Now there's going to be an onus placed on the service provider to track where that originated from and where it's going. Aimed obviously at reducing money laundering and those sorts of things. And I find it quite interesting that we're putting this on, again, the bulk of the people that are going to be affected by this are consumers, right? Yeah. Those that are trading the cryptos and transacting in the cryptos. What's interesting is there's a lot of accountability for what consumers are doing and what consumers are reporting on from a SARS perspective, a government perspective, whatever it is. And that's the job of SARS, to do that and to make sure that that's in place, right? At the same time, I'm struggling to remember if we have more than 3 state-owned entities that have had clean audits. The Pentagon recently just announced that they haven't had a clean audit in 7 consecutive years. But if you're a crypto trader in South Africa, you now need to be accountable for your transactions. That's what it is.
And it's wild because it's a blockchain. So we've spoken before that the blockchain is not as anonymous as you think, but it's also not that transparent. I mean, I can say this is coming from Jimmy Moyaho's blockchain, but I suppose I could prove it. But that's quite onerous on the service provider to know where and hence it's coming from.
Now, from a SARS perspective, I imagine the revenue services will say, well, you aided in the facilitation of money laundering or those sorts of things, and therefore we're going to come down hard on you. And I think we'll get, I'd love to get in some of the guys that we know in the space. I mean, we know the guys at Luna, we know the guys at Vala. We're going to get them into studio. We're going to get their thoughts on this because this does come into effect in April of 2025. So there is still a bit of time. Relax. We still can discuss this and debate it and figure it out. And I think that's what we're going to do. We're going to get in a couple of guys to get their thoughts around it. But the crux of the matter now is SARS is always going to be looking to get whatever it is they need to get out of it from a tax perspective and all of that. But more than that, it becomes harder to move money even harder than the traditional banking system, which defeats the purpose of what decentralized systems were meant to be, right?
But that was always going to be the case. I mean, there was always ultimately going to be increased regulation around crypto. And because of its anonymous to a fair degree blockchain, and as I stress again, not completely anonymous, but anonymous.
Partially.
Yeah. Well, it's also, if I publish my wallet and say, this is me, now everyone knows that's me forever and a day. And if you can see money coming and going from it, you can actually watch my transactions. It really is. I mean, so the increased regulation doesn't surprise me. I get what they're trying to do here. I get what FIC wants. I get why this is an issue around grey listing. I don't know practically how the Lunas and Velas and Binances and all the rest do it.
So, part of the information they have to collect: full name, identity number, residential address, the originator's distributed ledger address associated with the transfer, the originator's crypto asset account number with the ordering crypto asset service provider. So, there's a lot of details that are going to be required here. Now,
look.
Interestingly, I just want to add, it's for transactions. There's different kinds of requirements for transactions under 5,000 rand. So that's for transactions over 5,000. Under 5,000, you still have to collect the full name of the originator and beneficiary, the originators and beneficiaries' ledger addresses associated with the transfer. And I suppose here you don't need the residential address maybe, but there's those are as a minimum. Obviously, there are going to be different caveats, and there are things around private wallets. How do we deal with those?
Well, that's it. Mine's in a hardware wallet. But this is actually, you know what FIC's doing? I know what they're doing, right? They're trying to stop money laundering. And that's not true. I mean, if you're sending crypto from your wallet to my wallet, I can say, yo, dude, it's a pain, I know, but I need these details, and that's just how it is. And you would need them for me too, because of course it's a transaction. Fair enough. I get what they're trying to do. I understand all of this. You're not receiving Bitcoin from anonymous people unless you're a ransomware person. But then it's not anonymous. You know the company you've ransomwared and where it's coming from. The person paying it might have a challenge. Anyway,
there we go. Yes, because if I'm paying for that ransomware, or I'm paying for whatever hack has taken place, I'm going to so kindly send a follow-up email to those that have ransomed.
With proof of address.
Can I please have your proof of address? I need to submit it from
But here, you know what they're doing? They're de-anonymizing the blockchain. Because now they've got your blockchain number.
Full
and
transaction.
Suddenly they know all who you are.
Yes.
And so, I mean, it comes back to, if you've ever, SARS probably knows my blockchain number. I don't know, but it's de-anonymizing so that each of those little records we can start to say, well, that one's Jimmy, that one's Simon, that one's.
And that's the thing with a blockchain address. It's much like an ID. It's with you until you close that wallet. You're not going to suddenly say rejig and regenerate a new one, but that gives me an idea, which is probably going to be frowned upon in the legal fraternities. If you have a randomized blockchain, the same way you have a randomized authentication code that resets every now and then.
They've got those washing machines. I forget what they call them, but essentially they randomize you. So if you've done Dodge and you've received Dodge crypto, you put it into a washing machine system and it comes out the other side clean.
But that's what money laundering is. It's laundry.
It is money laundering. Yeah, it is.
Hence the washing machine reference.
Washing machine part.
Please don't launder money, folks. It's something that will get you caught. It's something that SARS will come after you for, and many other institutions, and you will probably end up in jail or in a different and awkward situation. But don't take it from us. If you don't want to, then no.
But I'm just wondering about. So I suppose the stuff in my hardware wallet.
How does that work?
Yeah, it's coming from me to me, I suppose. Because like one day I'm going to want to sell my Bitcoin, right? So then I've got to transfer it into an exchange.
Yeah, unhosted wallets, as they are, right? A CASP dealing with the transfers from these wallets will need to develop a process by which further information can be obtained. So then it comes back to what you were saying, Sai, about as someone entering something from an hosted wallet or from a hard wallet back into the ecosystem, I then need to declare, hey, this is whatever I've gotten, or this is where the origins of it are from, which again, the onus is not going to be on the CASP, the service provider. It's going to be on the client to say, you must declare this the same way you declare to SARS, this is what I need to declare. Excuse me. So that's going to be quite interesting from a CASP point of view. But these regulations are set to take place in April. We're going to have another conversation about these. We'd love to get your thoughts on it because that could inform the kind of follow-up conversation that we have. So please drop us comments, drop us messages, texts, whatever it is. We'll see if we can answer the questions because we have just as many questions as you do. But we're going to get to our wall because we need to update the wall. We need to add some pics to that. We're going to take a look at a couple of guys. So I want to look at Telkom.
Yeah.
Gave us results today, gave us a prelude to the results last week. Share price last week off the back of that soft announcement was positive. Now we've hit 30 Rand. You know, the last time we were at 30 Rand a share. I'll tell you the last time we were at 30 Rand a share. It wasn't any time recent. Okay, well, to be fair, we did touch 30 Rand a share a couple of times in recent times.
April, Jan.
Yeah. But the last time we were actually really significantly north of 30 Rand a share was probably around April of 2023, coming down from that bump up of the interest that was shown by MTN. Remember when MTN liked it and then we got up to 55 Rand and then nothing happened on that deal and we kind of came back and then we hit a slump. We honestly hit a slump after that. But now we're at 30 Rand on Telkom. Is this a good time to like the semi-private SOE?
So it's looking nice. Look, 30 is an important number to break through and move on higher. I thought the results, as expected, were good. There is some unlocked potential there. Of course, they've done some of that already with Swift. What do they call there? Is it
SwiftNet?
Yeah,
yes,
SwiftNet.
SwiftNet, 6.75 billion Rand unbundling there.
Which I thought was a little bit light, but anyway, that certainly helped.
That deal is still ongoing. I mean, it hasn't been finalized and all.
Yeah. And they've still, and the key thing about the results is that, they're no longer copper. It is good old-fashioned data, whether that be mobile via their mobile network or whether it be fiber in the ground. I still just think that South Africa doesn't have space for 4 mobile networks. I think Cell C and Telkom should tie up. I even think we might not be big enough for 3, but rather 3 than 2, perhaps. We want a duopoly. But I think we just need to tie up between Telkom Mobile and Cell C. And I think the Comcom would even allow it.
Who makes the move? Who makes the move? Does Sarame make the move at Telkom? Does George make the move at Cell C? How do you structure? Because, I mean, Cell C is still a wholly owned subsidiary of Blue Label Telecoms. The Levy brothers are still there. Do you then, as the Levy brothers, as Blue Label Telecoms, say, we're going to now, as we spoke about earlier, we spoke about it in one of these other episodes, to say, double down on the telcos, go buy a second one. Do you do that?
So I think it is in conversations. And, they could take it a step further. They could put Cell C on its, whatever this would be, Cell Mobile, Telkom, whatever it would be called. And they could list it and they could each own a third and put 40% on the market, third on the market or something like that, or wholly owned subsidiary. I wouldn't merge Blue Label with Telkom, although as I say that, why not?
So here's the thing, right? Look at the different kinds of spaces. Cell C is very clear on their MVNO strategy.
Yeah.
Speak to George, speak to anyone in his team, very, very clear about the fact that they're not going the infrastructure play. Your Telkom is your infrastructure play. They're not going the MVNO space. So they're not in direct competition, and one could argue that side of it as well. The Telkom business, the OpenServe business, strengthens the Blue Label Telecoms infrastructure from a fiber perspective, makes them more fiber competitive. But then you've got a Vodacom who comes back and says, but you didn't allow a massive deal to go through on the fiber side of it, but you're going to let this kind of deal go through. So creates a bit of complications, I suppose, right?
Yeah.
But that's a conversation for another day, right? Do we like Telkom at 30 Rand enough to put it on our wall? And if so, where? Because I'm not sure I haven't been surprised. I haven't been enticed enough. I want to see it break above 30 Rand, right? I mean, we've strangled along for the whole year below 30 Rand. To touch 30 Rand once or twice and not be able to break above it doesn't give me enough confidence to then, you know what I mean? So at the moment, I would want to say we're probably a bit more neutral on it.
Yeah, we can come back to it in 6 months' time with another set of results
and see where we move it from there. Okay, cool. But it is making our wall. It is joining a couple of other guys alongside it in the neutral space. The likes of Spar, the likes of We Buy Cars are on the wall there. The other one that we thought we'd look at is Old Mutual.
Yeah. So So asset managers in a bull market should be doing better.
Yes.
Right. Now these
Should be
aren't
outperforming.
Yeah, these aren't classic. I mean, they got rid of Quilter, which was their asset management business, but they've certainly got the all those money they take for their long-term products obviously goes itself into the market. Man, this is a stock that's just like, it's literally, I put a 5-year chart on and it's trading where it was 5 years ago.
It is. It is exactly where it was when, I mean, the pandemic in March of 2020, we got down to
Sub 10.
Sub 10, yeah. We got
But
9 rand, 9 rand 10
We
or
also
so.
got sub 10 in 22. We also got sub 10 in April of this year. And yes, now it's at 12 rand 80. So where's the growth coming from in a zero growth economy? Now, I think that, chatting with Sean earlier, I think that there is growth coming through into our economy. Can we get to 3% GDP? Yes. When? Well, I'd like next year, but it might be another year or two coming. They're launching a bank.
That's it. That was the other thing.
I know that they say we've got lots of customers already, but those customers are frankly overbanked already. I mean, you've got Time, you've got Zero, you've got Capitec, you've got all of these banks. You've also got things like PayShap coming, which is, nice and easy instant transaction from mobile to mobile. All of that sort of thing is there. The banks are expensive, but then look what Discovery did. I mean, Hilton Kellner got that to 1 million, a year and a half ahead of target, 1 million users. So
Yeah, but the Discovery
That is a
value
different
proposition has a couple of other things. So I mean, if you think about those that bank with Discovery that have the black and the purple cards and all of that, and the fast track through the airport and those kind of convenient things. What is your value proposition in a market
as Old
where
Mutual.
in a market where Capitec is targeting convenience and ease of use? You're going to compete with that, right? Because that's what you want to. That's what you want to compete with. Okay, fine. You don't compete with that. You say, fine. You already have your policy with us. Have an account with us. What is the benefit of me?
And of course, there's African Bank out there. I've forgotten about
That's
them.
it. So I now need to add to my list of banks. Do I? You know what I mean? Is it going to be worthwhile at 12 rand 80 with sideways movement for the last 5 years? I
Can't get excited about it.
That's my thing as well. I mean, even if you go in at 12 rand 80, my first worry is, are you going to have enough to break 14 rand? Because you haven't broken 14 rand in 2 years.
Yeah. And what's going to drive it? And if it does break 14 rand, what did other things do? I mean, what's Signia done if suddenly Old Mutual can run? I mean, or Sanlam, who I think is a much better play in the long-term insurance space. Old Mutual can't excite me.
Okay, so we have a couple of places on the wall we could probably put that. So neutral, alternative, avoid. We're not neutral on it. We're clearly not neutral. Avoid. There we go. We're not even going to look for an alternative for it. We're going to avoid Old Mutual for now until something else changes or until we get some new information. Let's look at some of the other picks that we had said we were going to put on the wall. We're going to add some international picks. If we've got time at the end, we might add a third local and a third international. But for now, let's look at the international picks. I want to look at DocuSign. Actually, do I want to look at DocuSign? Yeah, let's look at DocuSign. DocuSign Inc. I was debating DocuSign versus Starbucks. Perhaps we can do Starbucks at another time. But I want to look at DocuSign Inc. because you're in a digital world. They do the digital stuff. We saw in the pandemic, guys like Zoom shot off because people were suddenly having more Zoom meetings and buying Zoom subscriptions and all of that. Now DocuSign means we can sign documents anywhere in the world, and it's got full timestamps and audit trails and everything. Do we like it enough as a business to be saying DocuSign can make our
like
war?
the business, because you're right. It just, I'm old enough to remember having to go and sign documents and faxing things
physically.
around and
Yes,
physically.
yes.
I just wonder the threat of competition.
Yeah.
I mean, couldn't Microsoft just flick a button and make this happen?
Already embedded within their Microsoft system. Adobe does that already. Yeah, absolutely.
You're coming up against some really, really big players. The chart's looking not bad. It's broken out. We've got 16 holds, 2 buys, 2 strong buys, and a sell and a strong sell, which surprises me. Target price 65. It's at 79. That is a nice run. It's valuations on. I mean, there's no dividend coming through here. PE 17. Price to book is 8. I suppose the question is and they issue shares like there's no tomorrow. But that's par for the course in this type of a business, right? That's how you retain staff. So we're not surprised by that. Can it ward off the others, the Microsofts and everybody else. And it comes back to Zoom, which is a far superior product to Teams on almost every metric. But Teams is winning hand down because Microsoft is in pretty much every single corporate, and you just click a button and now you're in a virtual meeting. It's completely integrated with your email calendar and all of that sort of things. It's a tough fight to fight, surely.
It certainly is. It really, really is. I want to look at where we put it in terms of on the wall. I'm inclined to. You've raised some really valid points that have led me to think that we are probably going to have an alternative for it, or we are going to leave it in the neutral space. But I think
there's alternatives, and I think the alternatives would be boring old Microsoft and Adobe's and the like.
Okay, cool. We've got alternatives for it. We're not too crazy about it. We'll add it to our alternative space, and we'll see where we end up. The other one I want to look at is Occidental Petroleum.
I'd never heard of this one.
Many people haven't, and this is a personal favorite.
Okay.
For some weird reasons, right? So the backstory to Occidental was, I was doing the other show that we have done, where we give out some stock picks and some thoughts and recommendations. I did it a couple of, probably a year, maybe 2 years ago. And at the time, the share price was around the $30 range and that sort of thing. And I really liked it. And it had nothing to do with the Trump presidency. I really liked where we stood. It was around the conversations around what Occidental was doing. And I looked at the stock. And then after I gave it out as a stock pick, a certain gentleman who now holds $280 billion in cash went and loaded up on it, right? Now, I'm going to go to sleep for the rest of my life telling myself that I'm the one that gave him the stock pick. We both know that's not true.
I don't know. I mean, he could be listening.
He could be listening. But yes, Warren Buffett got into Occidental Petroleum. It ran hard. We touched north of $80. We're back now below $50. And that's why I bring it up. That's why I look at it now, because we've had the conversation. Trump is going to be drilling.
Drill, baby, drill.
Drill, baby, drill. Now, if we're going drill, baby, drill, are we not a US-based oil company?
Yeah. The concern would be that drill, baby, drills oil lower. We spoke earlier, mid-40s is not impossible, but then you just drill more. And most of these folks, particularly in the US, the frackers and the like, I mean, their cost per barrel is cheap. They've also got immense flexibility to turn off. If you're, I don't know, Saudi Arabia, Nigeria, turning off your production is not that easy. In America, if you're a fracker, you literally just like switch, done, come back next week when the oil price is high. Some T's and C's. Nigeria, of course, can't turn off because they need the revenue. Saudi Arabia can afford to. But short answer, yeah. And yes, the lower oil price will hurt them, and they just drill more.
Yeah, but a low oil price means you can drill cheaper so that in future you can sell higher anyway. So unless we somehow go from 80% of the world's fossil fuels being used at the moment, or 80% of the world's fuel being driven by fossil fuels overnight to 50%, guys, making oil probably still going to make quite a bit of money for quite some time. Where do we put it? Easy money? Do we like it? I don't think it's blue chip yet.
It's not blue chip. The chart is ugly. I like it. I like the idea. And if you I'm looking at a 20-year chart. I mean, and I appreciate oil's deeply cyclical. I mean, it's kind of in the middle of the range. So it's been as high as 80, as you say. It's been as low as 10, but that's obviously the pain. I mean, oil was negative. Yeah, a smidgen under $50.
It's not too bad.
I mean, the chart is not the prettiest in the world. But
this is a $50 rally from 50 to 80, you're still making 30%.
Yeah.
60%, sorry. 60%. Yeah, you're making double that.
Mm.
Right? So that's still a good return, right?
Yeah.
Cool. We'll figure out whether we put it in easy money or whether we like it, but we definitely do like it. And I think we are out of time on that note. We're going to leave the conversation there. Remember, folks, like, subscribe, follow, do all of those things, engage with us, give us feedback. We've been absolutely loving the engagement that we've been getting on our socials. You guys are amazing in our comments. We love the conversations. We love the thoughts. And we love the opinions. We love the different perspectives that people are providing to our conversations and to our topics. If you are looking for us, you can find us Insider Exchange, all socials. If we're not on any particular social, let us know. We'll get on that social. But I think we're everywhere. We're even on Threads, right? So
you're in Mastodon. No, Blue Sky.
Blue Sky. No, we're not on Blue Sky. What is Blue Sky?
It's me and about 12 people.
Okay, we're going to be the 13th person onto Blue Sky. Until next time, investing isn't hard. Just try it.